Hello students, in this video let us understand the asset related standard, that is IAS 16, property, plant and equipment. So usually we call it as PPE. Generally, property, plant and equipment constitute a significant portion of the total assets of an entity. So this property, plant, equipment, these constitute a portion of the total assets of the entity. You know about assets, right? Hence, this accounting standard is important in the presentation of financial position. So for this purpose, because of property, plant and equipment, this constitute a total assets. It is a portion of a total assets. That's why this is an important in the presentation of financial position. This standard discusses whether expenditure incurred should be capitalized as plant, property and equipment, or charged to profit and loss account, or depreciation, retirement of property, plant and equipment, and disposal accounting. So this has a material impact on balance sheet as well as on profit and loss account. What is the objective of IAS 16, that is a property, plant and equipment? The objective of this standard is to prescribe the accounting treatment for property, plant and equipment, so that users of the financial statements can understand information about an entity's investment in its property, plant and equipment, and also the changes in such investment. So this standard, this IAS 16 standard, which prescribe the accounting treatment for property, plant and equipment. What is the accounting treatment with regard to property, plant and equipment? So that the users of financial statements, who are the users? Internal users may be there, or else external users. So they can understand information about an entity's investment. So an entity's investment in its property, plant and equipment, and the changes in such investment. So the principal issues in accounting for property, plant and equipment are the recognition of the assets and determination of their carrying amounts, and the depreciation charges and impairment losses to be recognized in relation to them. So this is about the objective of IAS 16. Next, we will understand the definition of property, plant and equipment. So this property, plant and equipment are tangible items. You know that these are the tangible items, right? And tangible item means which are measured in terms of money, right? And these property, plant and equipment are held for use in the production or supply of goods or services, for rental or others, or for administrative purposes. So these property, plant and equipment these are tangible items. So these tangible items, these are held for usage or in production, or this can be held in the supply of goods or services, or for rental, or for others, or for administrative purposes. And these property, plant and equipment are expected to be used during more than one period. So these are tangible items, these can be expected to be used during more than one period. So this is about the definition of property, plant and equipment. As you know, this property, plant and equipment, these are the portion of the financial statement. So these are considered while preparing the financial statement of the business. Next, we'll understand the recognition criteria of plant, property and equipment. So this the cost of an item of property, plant and equipment shall be recognized as an asset. So these are called as an asset if it is probable that future economic benefits associated with the item will flow to the entity. Then only we can call it as asset. whether it is the future economic benefits associated with the item will flow to the entity, then the cost of this item of property, plant and equipment, that can be called as an asset, or else the cost of the item can be measured reliably, then only we can call it as assets, or cost of the item of property, plant and equipment can be called as asset. So this is the recognition criteria, and I hope this one is understood, right? So this is a cost of item of property, plant and equipment. This can be called as an asset if it is probable that future economic benefits associated with the item will flow to the entity, or else the cost of the item can be measured reliability. What is the measurement at initial recognition? An item of property, plant and equipment that qualifies for recognition as an asset shall be measured at its cost. If it is qualified for recognition as an asset, then it can be measured, or it shall be measured as its cost, or at its cost. The cost of an item of property, plant and equipment is the cash price equivalent at the recognition date. If payment is deferred beyond normal credit terms, the difference between cash price equivalent and the total payment is recognized as interest over the period of credit, unless such interest is capitalized in accordance with the accounting standard 23. Then we will discuss about the components of cost. Then what is the component of cost? How we can measure these assets in its cost? Or what are the methods of cost? So here the components of cost. The cost of an item of property, plant and equipment comprises, first one, its purchase price including import duties and non-refundable purchase taxes after deducting trade discounts and rebates. So the components of cost, first component is its purchase price, the purchase price of property, plant and equipment, and which includes the import duties. What are the import duties charged to supply or to purchase the property, plant and equipment, and non-refundable purchase taxes. As you know, the purchase taxes are non-refundable, and also after deducting trade discounts and rebates, we will get the cost of the property, plant and equipment. And also one more component is there, any costs directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. So here the management, they can fix some method of cost or components of cost to calculate the cost of that particular plant, property and equipment. And one more is there, the initial estimate of the costs of dismantling and removing the item and restoring the site on which it is located, and also the obligation for which an entity incurs either when the item is acquired or as a consequence of having used an item during a particular period for purposes other than to produce inventories during that period. So this is about the components of cost. The cost of an item of property, plant and equipment can be calculated by these three. If the purchase price including import duties, non-refundable purchase taxes after deducting the trade discount and rebates. So at the end we will get the cost price of the property, plant and equipment. Here the next one, accounting policy, measurement after initial recognition. What is the accounting policy? An entity that shall choose either the cost model or the revaluation model as its accounting policy and shall apply that policy to an entire class of property, plant and equipment. So an enterprise, they can select either cost model or revaluation model as its accounting policy. Understood? So and they can, or that policy can be applied to an entire class of property, plant and equipment. There are two types of accounting policies, that is cost model and revaluation model. Let us understand what is cost model. So first one, cost model. After recognition of an as an asset, so after the recognizing that is an asset, an item of property, plant and equipment shall be carried at its cost less any accumulated depreciation and any accumulated impairment losses. So in cost model, after recognizing these items are as an asset, an item of property or an item of plant and equipment that can be carried at its cost, but deduct any accumulated depreciation and any accumulated impairment losses. This is the first model, that is the accounting policy. First accounting policy, that is cost model. And second one, revaluation model. So after recognition as an asset, so I already told in the first slide, so recognition criteria. What is the recognition criteria of an item of property, plant and equipment? It is probable that future economic benefits associated with the item will flow to the entity, or else the cost of the item can be measured reliably. Then only we can call it as an asset. So in the revaluation model, after recognizing as an asset an item of property, plant and equipment whose fair value can be measured reliably shall be carried at a revalued amount. But in the cost model, the equipment, the cost of that property, plant and equipment shall be carried in its cost. Understood? But in the revaluation model, the fair value can be measured reliably shall be carried at a revalued amount, being its fair value at its date of the revaluation, and also from that deduct any subsequent accumulated depreciation and subsequent accumulated impairment losses. So revaluation shall be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using fair value at the end of the reporting period. So this is about the measurement after initial recognition. After recognizing these items as an asset, so these are two types of accounting policy, that is cost model and revaluation model. In the cost model, first we carry the amount, or we carry these items or these assets at its cost, but deduct accumulated depreciation and accumulated impairment losses. But in the case of revaluation model, whose fair value can be measured in terms of revalued amount, being at its fair value at the end of revaluation, but deduct the subsequent accumulated depreciation and subsequent accumulated impairment losses. So this is about the accounting policy of the property, plant and equipment. If an assets carrying amount is increased as a result of revaluation, the increase shall be recognized in other comprehensive income and accumulated in equity under the heading of revaluation surplus. However, the increase shall be recognized in profit or loss to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit or loss. Also, if an asset's carrying amount is decreased as a result of revaluation, the decrease shall be recognized in profit or loss account. However, the decrease shall be recognized in other comprehensive income to the extent of any credit balance existing in the revaluation surplus in respect of that asset. And next we will discuss about depreciation. What is depreciation? All of you know about the depreciation, right? So depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Depreciable, or this is an depreciation means it is a systematic allocation of the depreciable amount of the particular asset. Take for example property, plant and equipment, or else buildings, or else any, you can take any asset. So depreciation means these are the systematic depreciable amount of an asset over its useful life. And depreciation or depreciable amount is the cost of an asset or other substituted for cost less its residual value. So depreciable amount is the cost of an asset. This is the depreciable amount means these are the cost of an asset or other amount substituted for cost less its residual value. And each part of an item of property, plant and equipment with a cost that is significant in relation to the total cost of the item shall be depreciated separately. So each part of the item of property, plant and equipment with the cost that can be depreciated or related to that property, plant and equipment that can be depreciated separately, or total cost of that separate item of the property, plant and equipment that can be or that shall be depreciated separately. The depreciation charge for each period shall be recognized in profit or loss unless it is included in the carrying amount of another asset. So depreciation charge for each period we have to charge some amount of depreciation for an asset, right? So the depreciation charge for each period shall be recognized in profit and loss account unless it is included in the carrying amount of another asset. So these depreciable amount that should be recognized as in profit and or loss account. And also the depreciation method used shall reflect the pattern in which the asset's future economic benefits are expected to be consumed by the entity. And also one more definition is there, that is useful life and residual value must be reviewed at least at the each financial year end. So if expectations differ from previous estimates, the changes are accounted for as a change in accounting estimate. There are so many types of depreciation methods, as already you have studied these things, right? Straight line method, diminishing balance method, sum of a unit charge based on expected user output, or review periodically methods. So these are the depreciation methods that can be used to charge property, plant and equipment. Here is one example is there, but for in your syllabus there is no practical questions on this standard, okay, but one example is there. Look at that. The price paid for machine, so machine is an asset, the price paid for machine is rupees 1,10,000 rupees. That is included 1 lakh for machine plus VAT of rupees 10,000. So total 1,10,000. The entity gets a credit of rupees 10,000. So while they purchasing the machine, they get credit from the company of rupees 10,000. So while calculating the tax payable on the finished goods sold, so they get credit of rupees 10,000 while calculating the tax payable on the finished goods sold. So for that machine additional costs are incurred. So additional costs are freight rupees 2,000, import duty 5,000, installation expenses rupees 1,000, and the initial estimate of dismantling and removing the item is rupees 3,000. After the machine was put to use, rupees 1,500 was spent for maintenance. That is after the machine was put to use. So calculate the initial cost of the asset and justify your reasons as per IAS 16, that is Indian Accounting Standard 16. So in this question they are asking to calculate the initial cost of the asset. So while you are calculating the initial cost of the asset, which includes, I already told, while you are calculating the cost of the asset, which includes purchase price which includes purchase price plus freight or import duty, whatever it may be, or installation expenses, or initial estimate of dismantling and removing the items, these are included in the initial cost. But at the last they are given that after the machine was put to use, rupees 1500 was spent for maintenance. So maintenance charges of rupees 1500 are to be shown as an expense in the statement of comprehensive income and income. So this 1500, this is shown as an expense in the statement of comprehensive income. So this is not as an asset. Understood? So because this expense is incurred after the machine was put to use, that is 1500. That's why that's are shown as an expense in the statement of comprehensive income, not in the asset or not as an asset. So here is a solution. The cost should be computed as first purchase price. Purchase price is rupees 1 lakh, which include a refundable tax, that is rupees 10,000. So while calculating the initial cost of the particular asset, we are not supposed to include that VAT, that is rupees 10,000. So the purchase price only 1 lakh. So 1 lakh 10,000 is including the VAT. Right, understood? And yeah, because here they get credit of rupees 10,000 while calculating the tax payable on the finished goods. That's why it is 1 lakh. Sorry for that. So here purchase price 1 lakh 10,000, inclusion of 10,000, but in the question they have given that they get credit of rupees 10,000 while calculating the tax payable on the finished goods sold. So that is excluding refundable tax. I hope this one is clear, right? So that's why it is a 1 lakh, and it includes additional cost, that is freight, that is rupees 2,000, import duty 5,000, installation expense 1,000, and initial estimate of dismantling and removing the item rupees 3,000. That's why the total initial cost 1,11,000. I already told that maintenance charges of rupees 1,500 are to be shown as an expense in the statement of comprehensive income. It is not as an asset. That you have to keep in mind. These maintenance charges are after the machine was put to use, are incurred after the machine was put to use. That's why that are shown as an expense in the statement of comprehensive income. I hope this one is clear, right? If you want, again read it. The price paid for a machine rupees 1,10,000, 1 lakh plus VAT of rupees 10,000. For that, entity gets 10,000 while calculating tax payable on finished goods. That is a credit. That's why that purchase price is 1 lakh. And additional costs are freight 2,000, import duty 5,000, installation expense 1,000, and initial estimate of dismantling and removing item 3,000. After the machine was put to use, 1,500 for maintenance. But the maintenance charges of rupees 1,500 are to be shown as an expense in the statement of comprehensive income. I hope this one is understood, right? If you have any doubts, you can clarify it. Thank you.